Nobody robs you dramatically. That is the part nobody tells you. There is no moment of crisis, no sudden alarm, no morning you wake up and discover that everything is gone. What happens instead is quieter, slower, and in many ways far more damaging than any single financial mistake you could make. Money leaves, a little at a time, through gaps so small and so ordinary that most people never think to look at them. And by the time the total becomes visible, if it ever does, years have passed, and the compounding effect of all that slow, silent loss has done its work. I have spent more than 4 decades in this industry. I have sat across from people who were careful, who were intelligent, who had worked hard their entire lives and saved faithfully, and arrived at their 60s believing, reasonably, that the difficult part was behind them. And then I would look at the actual flow of their money. Not the big picture, not the portfolio summary, but the granular detail of where every dollar was actually going every single month. And what I found, almost without exception, was the same thing. Leaks. Slow, invisible, consistent leaks that nobody had ever pointed out to them. Not because anyone was hiding it, but because nobody had ever thought to look. I want you to understand something about where I am coming from before we go further. I am not here to tell you that you have made mistakes. I am here to tell you that the financial system you are operating inside was designed with assumptions that made sense at 40 and stopped making sense somewhere around 60. And nobody updated you when the rules changed. That is not your failure. That is a failure of information. And information, once you have it, changes everything. Maybe you know what I am describing already, in some quiet, unexamined way. Maybe there is a number that comes to mind when you think about your monthly expenses, a number that always seems slightly higher than it should be, that never quite lines up with what you thought you spent. Maybe you have had the experience of looking at a bank statement and feeling a kind of vague unease, not because anything is obviously wrong, but because nothing is obviously right either. Maybe you are comfortable enough that it does not feel urgent, which is precisely the condition under which this kind of loss does its most damage. Urgency would make you look. Comfort allows the leaks to run for years. What I want to share with you today is not a warning. It is a map of where the money actually goes, not in dramatic crashes, not in obvious errors, but in the slow, ordinary, entirely preventable ways that most people over 60 lose hundreds, sometimes thousands of dollars every single year without ever knowing it happened. I need to take you back to a conversation I had in the autumn of 2009. A woman named Margaret came to see me, 71 years old, recently widowed. Her husband, Robert, had handled most of their finances during the marriage. She was not in crisis. She had savings. She had a pension that covered her basic needs. She was, by any reasonable standard, fine. But she had come to me because in the 6 months since Robert had passed, she had been paying close attention to the money for the first time in decades, and something felt wrong. She could not say what exactly, just that the numbers seemed to drain faster than they should. We sat down together and went through everything. And what we found over the next 2 hours was not one large problem. It was 17 small ones. A home insurance policy that had been auto-renewing at an escalating rate for 9 years, without anyone reviewing whether the coverage still matched what she actually needed. 3 subscription services she had either forgotten about or genuinely did not know were still being charged, relics of accounts set up years before. A savings account that had been holding a significant portion of her liquid assets at an interest rate so low it was effectively losing value against inflation every single month. A phone plan designed for a household of 4 that she had been paying for alone since her children left home in the 90s. Bank fees on a checking account that a single conversation with her bank could have eliminated entirely. Fees she had been paying for so long they had become invisible. None of these were catastrophic. Each one, examined in isolation, seemed almost trivially small. But added together, across a year, they came to just under $4,000. $4,000 that had been leaving her life, quietly and consistently, every year, for years. And the number that struck her, the number that made her go very still and quiet for a long moment, was not the annual figure. It was the decade figure. The amount that had left in the 10 years before Robert died, through these same invisible channels, while they were both alive and neither of them was paying attention. She said to me very calmly, "We always thought we needed to earn more. We never thought to check what we were already losing." That sentence has stayed with me for 15 years, because it describes, with a precision I could never have manufactured myself, the fundamental error that most people over 60 make about their financial situation. The attention goes to income, to the portfolio, to the return on investments, to whether the number is growing. And all of that attention, directed outward and forward, leaves the back door completely unguarded. And the back door is where the money actually leaves. Let me tell you what I have observed, across hundreds of conversations, about how this happens. The first and most consistent pattern is what I think of as legacy costs. Expenses that were set up at an earlier stage of life, for an earlier version of your circumstances, and have continued running unchanged while your life transformed around them. Insurance policies are the most common example. When you are 45 with a mortgage and children at home and a spouse who depends on your income, a large life insurance policy makes complete sense. When you are 68 with a paid-off home and grown children, and a retirement income that does not depend on your continued employment, that same policy may be costing you a significant amount every month for coverage that no longer matches your actual needs. The policy did not become wrong overnight. It became wrong gradually, as your life changed, and because it was set to auto-renew, it simply kept running. Nobody reviewed it. Nobody asked the question. And the money kept leaving. The same pattern applies to home coverage that still reflects the replacement cost assumptions of 15 years ago, to car insurance policies that have never been compared against the current market, to health supplements and vitamin subscriptions ordered once and never canceled, to streaming services, software licenses, memberships in organizations that no longer reflect your actual life. These are not luxuries you chose and decided to keep. These are remnants of choices made long ago that are still extracting money from your life on autopilot, month after month, because the system defaults to continuation, and the path of least resistance is to never review. The second pattern is what I call invisible inflation, the slow, steady erosion of purchasing power that does its damage not through any single dramatic event, but through the simple, relentless passage of time. If you are keeping a significant portion of your savings in an account that earns less than the rate of inflation, and a remarkable number of people over 60 are, because they moved money into what felt like safe, conservative positions years ago, and have not revisited those positions since, then your money is not sitting still. It is shrinking. Slowly, in real terms, every single month. Not because you made a bad investment, because you made a reasonable decision at one point in time, and then did not update it as the world changed around it. This is the part that genuinely troubles me, because it is entirely invisible on the surface. Your balance may look stable. The number on the screen may not be decreasing in a way that triggers alarm. But if your cost of living is rising by 3% a year, and your savings are earning 0.5%, the gap between those two numbers is a loss, a real loss, measured not in what you can see, but in what your money can no longer buy. And that gap, left unaddressed, compounds. Every year it widens slightly. And a decade from now, the purchasing power of money you thought you were preserving will be substantially less than it is today. There was a man I knew, I will call him George because he would not want his name used in this context, who had moved a large sum into a money market account in 2011 because the market had frightened him and he wanted to feel secure. He felt secure. The number on his statement looked stable. He checked it every few months and felt reassured. What he did not do, for 12 years, was calculate what that money would have needed to earn just to stay even with inflation. When we finally sat down and did that calculation together in 2023, the difference between what he had and what he would have had if the money had simply kept pace with the cost of living was significant enough that it changed how he thought about his financial situation entirely. He was not angry. He was something harder to name than anger. He said, "I thought I was being careful." I said, "You were being careful. You just didn't know which thing to be careful about." That is the heart of it. The people who lose money slowly and silently after 60 are not careless people. They are careful people who were careful about the visible things and did not know to look at the invisible ones. And the invisible ones, the legacy costs, the inflation gap, the fees that have become part of the background noise of financial life, the policies and plans and subscriptions that keep running because stopping them requires an action, and continuing them requires nothing at all. Those are where the real losses accumulate. The good news, and I mean this genuinely, is that of all the financial problems a person can face, this one responds more quickly and more completely to attention than almost any other. You do not need to earn more. You do not need to take more risk. You do not need to make any large or irreversible decisions. You need to look carefully, systematically, without the assumption that because something has been running for a long time, it must therefore be correct. Set aside one afternoon. Pull every recurring charge from your bank and credit card statements for the last 3 months. Every single one. Write down what it is, what it costs, and whether the coverage or the service or the benefit it provides still matches your actual life today. Not the life you were living when you set it up, but the life you are living right now. Call your insurance providers and ask, specifically, whether your current coverage is the most appropriate option for your current situation. Ask your bank what fees you are paying and what it would take to eliminate them. Look at the interest rate on every account holding significant savings and ask honestly whether it is keeping pace with inflation or quietly losing ground to it. This is not complicated work. It is not exciting work. But in my experience, the people who do it, the people who spend one focused afternoon looking at the back door instead of the front, almost always find something, usually several somethings. And the cumulative value of what they find, directed back into their financial life and allowed to compound over the years ahead, is often more meaningful than anything that could be achieved by chasing a higher return on their investments. Margaret, after our conversation in 2009, went home and spent a Saturday doing exactly what I have described. She called me the following Monday. She had found an additional $600 a month that had been leaving her life through channels she had never examined. $600 a month. She was 71 years old. She was not wealthy. And for 10 years, every single month, that money had been going somewhere that was not her life. She said to me on that Monday, "I feel like I found a room in my house I did not know existed." I want to ask you something before you close this video. Not about your portfolio, not about your returns, not about any of the things we are usually told to think about when we think about money. When did you last look at the back door? When did you last sit down with every single recurring charge in your financial life and ask, honestly and specifically, whether each one still belongs there? If the answer is that you cannot remember, or that you have never done it in quite that way, leave me a comment below. Tell me what you found when you looked, or what stopped you from looking. I read every one. And I think you will find in the comments that you are far from alone.